Now, Peter, I'll start with you because I know you're not the biggest supporter of this action by the Fed, and we just saw Mike's chart there. Do you think the announcement of their intention to do this will significantly outweigh the impact of the actions themselves, or could there still be some improvement in credit outlook to come?
No, I think you make a great point that it's more of the signaling, because I actually don't think that the Fed is going to want to buy too many investment-grade bonds. Certainly, I don't think they want to buy really much of any of the high-yield space, but I think that they feel like they need to do this, but I don't think they want to get in so deep, similar to the BOJ or the ECB. But the question is what are they trying to address here? I mean, one of the major problems in March was liquidity, or the lack thereof. Well, I argue that a lot of that was, well, post-Volcker rule, where big investment banks would have stepped in and would have been intermediaries to buyers and sellers. That entire market disappeared, and that's why you had these vacuums in markets that the Fed claims now they're trying to address. Or on the other hand, are they just trying to buy time for companies by allowing them to extend maturities until we get to the other side of an economic recovery?
Sarah Bloom Raskin, how would you answer that? What is the Fed trying to do here?
Sarah Bloom Raskin, how would you answer that? What is the Fed trying to do here?
Well, what the Fed should be focused on, of course, is a full economic inclusive recovery. And to the extent it is using its tools, it wants to make sure that its tools are focused right where they need to be, which is on the real economy. So ideally, the Fed is looking through markets to the effect of these corporate debt purchases on employment, on essentially the ability of firms to hold on to employees. That should be really ultimately what the Fed should be caring about. That's its dual mandate. That's what it needs to focus on.
Sarah, if we were to see a second wave and with it the need for a second lockdown or any other big unexpected secondary negative economic shock, do you think negative rates are a possibility?
Well, the president certainly has been pushing for negative interest rates for quite a while. But if you look at the panoply of tools that the Fed has used, it has put out more unprecedented types of ammunition than we have ever seen. And it's not just today. It's not just what we're seeing in terms of the corporate bond purchase facilities, but it's going to be working with state and local municipal bond issuances. It's now doing the Main Street lending program. So it has entered the arena in terms of everything possible in a much more unprecedented way than we've ever seen. So negative interest rates, that just seems like, that seems like dessert when the main course is plentiful.